Okay, Chapter 9, Market Efficiency and Behavioral Finance. So last class I talked about the learning goals of this chapter, and we look at efficient markets, and we're going to sort of talk about decision traps and behavioral finance, and try to link that to technical analysis and ideas for when to buy and sell stocks effectively. Okay, so we have this random walk and efficient market concepts and hypotheses and ideas. And the idea is that stocks move in a random, completely unpredictable nature. So stocks are these completely unpredictable entities that move when and wherever they want, and no one can predict it. So don't bother doing any stock analysis. Don't bother looking into or reading about any stocks. Just pick 30 or 40 stocks randomly and invest in them, because there's no really way of telling where they're going. So that was this theory. So there's no patterns. There's no, the markets are just completely efficient and respond to any changes that become available. Just respond immediately. So there's nothing that you can think of that isn't already in the price of the stock. Pretty disappointing, right? Pretty sort of like, well, why bother? That's sort of like that concept, ever hear people say that, oh, when it's my time to go, it's my time to go. That's sort of like saying it's out of your control when you're going to die. But we know that that's not 100% true, because if you have exercise and diet and avoid riskier actions and behaviors and hobbies, that you could probably do a good job extending your life. Now, the efficient market is sort of the refined theory where we say that because the stocks reflect all the possible information in a quick and timely fashion, anytime you look at the stock price, it's the correct price for the stock. So the concept is, if we have millions of people buying and selling the stock, creating the supply and demand market, then whatever the price of the stock is the true and actual price of the stock. Because all these people have looked at the financials, all the information, all the products, and they judged the value of the stock, and they purchased it. And that's the correct value of the stock. So you don't have to worry about looking for that any stocks are overvalued or undervalued. They're all correctly valued, is what the efficient market likes to talk about. So to have an efficient market, you must have knowledgeable investors actively analyzing and trading stocks. You must have information must be widely available to all investors at the same time. And thanks to the internet, we have that. Events such as labor strikes, accidents, Ebola, tend to happen randomly. And Ebola was a huge effect on the market. Certain stocks and the market fear level in general was heightened with this Ebola panic that we had about a week ago. And investors react quickly and accurately to all new information. Now I agree with the first three. The last one I'm a little bit not sure of, because I don't think investors react. They may react quickly, but I don't think they necessarily react accurately. And you could see this in certain earnings reports. An earning report will come out, say Amazon last week, and the stock will get punished. Or even Yelp, the stock will be very punished, but then sometimes it's overly punished, and the next day people kind of think, well, this was, an overreaction, and the stock drifts up again and moves up. So it wasn't accurately, the new information wasn't accurately applied. It was over-applied, Or sometimes the stock will come out with an earnings surprise, and the stock will jump up a great deal, but the next day it will come down because they got a little too enthusiastic and a little too much demand and overvalued the stock for a day. So I've seen plenty of instances where investors, sometimes they don't react quickly. A piece of news will come out and they won't realize the significance of it until much later. Or they may overemphasize this news. I remember there was a quarter where Under Armour came out and their inventories had expanded faster than analysts had thought they should, and the stock lost 30% of its value. And it turned out they were expecting big sales, so they're increasing the inventory to meet the expected new demand. So it turned out not to be a bad thing, but people overreacted. Here is Walmart's quarterly revenues. And you could see that, you see how there's always that spike? Why do you think there's those spikes in their quarterly revenues? Yes, Christmas. People do a lot of, have you ever been to Walmart on Thanksgiving night? Sometimes I go, not to go to Walmart, to see how many people, how many fools are sitting in the cold. And that line wraps around for a while. Did you see the video last Christmas of the Walmart in Puerto Rico? Where they broke through the barricades and they all rushed into the store, and it was a madhouse. You know. So you've never hollered Black Friday, go shopping at all? Yeah. I try not to go shopping on Black Friday. It's whatever money I'm saving is not worth the pain, aggravation, and time I'm spending. I'd be better off doing some sort of work that day and just making probably more money than I would ever save by trying to, you know, do all these crazy Black Friday events. I know Best Buy is crazy for them too. Like they do a lot of advanced promotions. You have to get there early, and you have to wait in line and get a ticket, and you know. They're improving the process, but they're moving it more and more into Thanksgiving, where it used to be like, you know, early Friday morning, like very early, like 3 a.m. or 5 a.m. Now they're pushed all the way to Thanksgiving, and you know, what's the one store that will not, a big shopping store that will not be open on Thanksgiving? Costco. They close on most major holidays so their employees can have off, which is nice. Here's Walmart's stock price, which is a little bit different than, you can see that even though they've increasing their quarterly revenues, it doesn't necessarily always translate into an increase in Walmart's stock price consistently. I mean, the stock price is trending higher, but there's a lot of other factors besides the revenue. Sometimes it has to be, how is the profits? Are the profits also going up along with revenue? If profit percentages are going down and revenues are going up, then that's not good for the stock. This is a concept that surprisingly a lot of students have a problem with. When I do the simulation in the finance class, and students say, well, I doubled my sales, how come my stock price went down? I said, because you don't have any profits. You doubled your sales because you're basically giving $500 away with every car. You're losing $500 in every car. Why would your stock be rewarded for that? But I got so much more in sales, man. And I'm like, well, investors don't care so much about sales. They care about profits. And I'm like, just think, if you owned a business, would you care, if say you owned a bakery, would you care if you had, you know, you went from $100,000 in sales to $1 million in sales, but when you had $100,000 in sales, you had a $50,000 profit. Now you have $1 million in sales, you have a $500,000 loss. What would you rather have? And that's basically what investors, why they look at profits so closely. They do like increasing revenues. There's no doubt about that. They do like them, but only if it comes with a stable or growing profit margin. So they want companies that are able to figure out, how can I increase my profit margin while increasing my sales? Not an easy thing to do. In fact, they're more forgiving for a company that may be having flat sales but increasing profit margins to make up the difference. Okay, so they put this into a hypothesis called the EMH, Efficient Market Hypothesis, and it comes in 3 forms: weak, semi-strong, and strong. Kind of like coffee, right? I went to Starbucks the other day, and I said, they're like, what would you like? I like a PSL. And the girl was like, what? I'm like, what's your first day? PSL. Tall. And then somebody else, the more experienced worker, came and threw her aside and was like, I got your order. Would you like whip with that? I'm like, yes. It's the fall, PSL. Yeah, pumpkin spice latte. In fact, they have new posters and banners inside. What was really hilarious is because they had a poster that said PSL on it. That's where I got it from. I didn't make it up. I wasn't trying to be a jerk and make up an acronym. The poster said, get your PSL. So I was like, yeah, PSL, tall, whip. Let's go. very rich though. That's why I only get the tall, which is code for their small, which is smart. It's like McDonald's is the same thing. There's no smalls at McDonald's or regulars. Regular, medium, large. At least when I worked, I don't know if they changed it. Because they don't want anybody to feel like they're buying the small. You know, it's a psychological thing. You want the tall, because tall sounds big. But it's really the small. But you don't feel like, you know. My idea was, yeah, like call it small. Call it loser. Call it you're too cheap to buy the bigger size. So people will buy the bigger size because you make more money in the bigger size. Shut up. Get back to the lecture, asshole. Oh, okay. Tough crowd today. The weak form is probably the one that most people could buy into because it's basically saying that you can't use future predictors or data on stock prices, past data on stock prices to create future predictors of stock price. So this is basically saying that technical analysis doesn't work. You can't use charts or past points, stock price points, to kind of as a sign for the future stock price. So you can't look at a chart and say, by the looks of this chart, the stock price is going up. And most people agree with that. You can't just look at the stock chart and say the price is going up. However, they do agree that, you know, if you do good financial analysis, industry analysis, that you can make money if you have a good financial analysis or inside information. Those two things in a week will be one way to make money in a weak form of the official market. In the semi-strong form in the official market, it's going to say that actually, there's full slides on these, so I don't know why or is there? No, there's not. I thought they had full slides. The semi-strong says that you can't use, it's everything that you can't do in the weak form, which is technical analysis or price movements or charting. But in addition to that, the semi-strong says you can't use fundamental analysis, financial ratios, accounting information. You can't make big profits in the stock market by using public information, which is the financials. Or technical information, which is analyzing price movements and signs. But you can use inside information. So with the semi-strong, inside information works, but fundamental and technical analysis does not work. And in a strong form, nothing works. Inside information, technical, or fundamental analysis, none of that works. Everything is completely random. There's no information, public or private, that will allow investors to consistently earn abnormally high returns. And most people don't feel that's true. Because if you have a juicy piece of inside information, you should probably let me know about it. I'm not going to trade on it. I'm just going to, just see what happens with it. But people who've had really good pieces of inside information, like such as they know that the FDA is going to approve this drug and announce it tomorrow, that's a pretty good piece of information. Could trade on that. However, the strong form says it won't work. Okay, so here's some price reactions around a positive announcement. So there's a positive, this is the stock trading on any particular day. A surprise or positive stock earnings announcement comes up and the stock price jumps. This is earnings seasons, and I'm seeing this with a number of stocks where the earnings come out and they beat revenues and profit estimates, and the stock price goes up. And the reason for that is what we learned about in Chapter 8. People are predicting future stock prices based on expected earnings and profits. If their calculations are low on their expected earnings or PE ratios and profits, and they come out higher than what they forecasted or what the company predicted, then there's going to be a correction in the stock. But a lot of times that spike gets reversed the next couple of days. It's sort of, people get a little over reactive to it. There are things called calendar effects, and this year we had the calendar effect in January is a calendar effect where if there's a weakness in January, the first week, And in the first month, if stocks go down, it says the whole year should be negative. And we did have a lot of weakness in January that would say by December 31st, stocks overall for the year should be down. Kind of looked like that was happening in October, but we rebounded nicely. There's also the weekend effect. Stocks do poorly on Mondays, and especially if it's raining on Monday. Because people are just more pessimistic, more not so optimistic on Monday, and there's a lot more selling than buying on Monday. And then during the week, it gradually shifts. So they have what they call this weekend effect. There's an effect called the weather effect, like I was saying before. Sunny days, typically stocks go up more than rainy days. If it's a large section of the country is covered by clouds and rain, they typically notice the stocks go lower than when the country is more sunny and warm and nicer weather. So there are these calendar effects. There's one calendar effect at the end of December. Stocks that have gone down, a lot of people like to sell to lock in the tax reduction. So sometimes stocks that have gone down a lot for the year, they may even go down a little bit more in December because people are looking to sell them to collect tax on them. And then they buy them again. They have to wait at least a month, and they buy them again in January, and then usually push the stocks up in January. There are small firm effects. The size of the company's firm affects return. So smaller firms typically outperform larger firms in return and in stock price valuation, in the appreciation of stock price. And you could kind of, the basic, I think, understandable piece here is that if you have a small company, it's easier for them to double, triple, quadruple in sales. So if you have a small, they only have 5 or 10 retail outlets, it's easier for them to have 20, 40, 100. But if you have something like Starbucks and there's already 7,000 of them, how do you get another 7,000 in a year? Not so easy. So small businesses can grow faster and increase sales and returns much faster than very large companies that are going to be very difficult for them to double their size. Earnings announcement drifts. Whenever announcements come out for earnings that are unexpected, the stocks usually react up or down depending on whether the announcement's good or bad. And it sometimes can be, people take advantage of it. If they feel like the stock's been overly punished, they'll buy into it to sell it the next day because it usually comes back a little bit. And a lot of times what happens is the stock, the news gets out, oh, this missed their targets, this whatever, and the stock went down 20% today. Then a lot of people see that news and say, I'm going to buy it tomorrow because it's a good price to get in. And the stock pumps up a little bit. So we have these routine anomalies as far as this drift on momentum. Value effect. Stocks, we have PE values. Stocks that have low PEs typically outperform stocks that have higher PEs. So this is an anomaly because we'd expect the opposite. Stocks that have high PEs or high performing or high return stocks should have better returns. But typically low PEs as a group compared to the high PE stocks have a better return. And we're not really sure why. This is just a graphical look at positive earnings announcements versus negative earnings announcements. And sometimes you'll have a negative or positive earnings announcement, and the stock will go down a huge amount that first day, then usually rebound in the opposite direction the next day, but then the drift happens for a longer period of time after that the stock continues to go up or down. It creates a momentum. So stocks that have multiple negative announcements will create this negative downward momentum. And stocks that have multiple positive announcements or beat their earnings in consecutive quarters will continue to have a positive drift or momentum. So that's why in the virtual stock exchange that we're playing, I sold Yelp and Amazon because they had negative announcements, figuring that there would be this drift that would pull them lower. Although I didn't realize the stock market would rebound 600 points in the next couple of days, which the market, the overall market return, sort of like that tide lifted everything up, which negated any drift effect that I was trying to trade on. So there are things that you can't control because that's a systematic risk. If the market's just going to push up back to 1,700 from 16,000 to 17,000, all stocks are going to feel a positive effect from that. So it's going to be hard to play a market drift when the market's working against you, the tide is working against you. So possible explanations, stocks that appear to have very high returns may seem riskier, and that could be the reason for some of these high fluctuations, because the risk can change dramatically if unknowns come up. If they're already, like, these stocks are an edge. These stocks that have these high valuations, the high prices, investors are just waiting for some reason to collect their profits and run out of them. So it can be a very volatile game. Some of these anomalies just may be a chance coincidence. That it's just, there's no reason, it's just chance. And some of them may be created by people's own behavior. These repeated mistakes or behaviors that people make when they trade create these inefficiencies in the marketplace. Especially small, uneducated, unexperienced investors who tend to do the same behavioral traits that push the market in certain directions that more experienced traders can take advantage of. And they'll create these anomalies that people see these patterns developing. Now, talking about investor behavior and security prices, a big problem is overconfidence. And some of you maybe experienced this in the virtual stock market, where you're making trades and you're making money. Maybe you made $100,000, $200,000 in a Verker, and then you're going to say, I am just great at picking stocks. I'm going to need to start doing this with my own real money. And suddenly you start doing it with your real money, you find, hey, I'm not making the same money I was making when I was playing the game. What's the difference? For some people, it's that you're more cautious with your own money, which may be a good thing in this respect. But some people may continue to be overly confident and make risky moves with their own money, but then get nervous when it doesn't go in the right direction right away and sell much more faster than you would when it's not your own money. So sometimes you're a little bit more patient when it's not your own money and give it a chance to make a profit. And your own portfolio may, get scared and sell out quickly within the next couple of hours if it doesn't move in your right direction. But overconfidence can develop if a market is going to be a bull market and move up aggressively for 3 years. Everyone makes money and there's probably no wrong stock to buy. But that's going to make you think that it's just easy money all the time, and when the bear market comes in, you'll be unprepared and probably lose everything you made in the bull market, then some. There are other biases that people can have. A common one, self-attribution bias, where you want to support your own success and take credit for your success, but blame others for your failures. And in the stock world, you want to talk about all the successes. I picked this stock, it made money. I picked that, it made money. I'm just so wonderful, and I have a big ego, and I just do great. But whenever something fails, you fail to mention or tell anybody about it. So it seems like you're a wonderful stock picker. You only talk about your successes. And if something failed, it's someone else's fault, or something out of your control. You shouldn't be blamed for it. It shouldn't really be affect you. So you tend to follow the information that supports your beliefs, but then discard conflicting information. So you're not learning from your mistakes, basically. So when you do something right, you're willing to take credit for it, but if you do something wrong, you blame others and never learn from the mistake, which means you're likely to repeat that same action. So, both of these things can cause you to trade too frequently, which is known to people who trade more frequently, statistically make less money than people who trade less frequently. All right. Loss aversion, and this is where you buy a stock and you start losing money on it. And you don't want to sell it because you want to hold on to your proven right. And I've done this before. It's just a natural human tendency that you want to hang on, hoping that the stock will bounce back. Maybe you bought a stock, you talked it up a great deal, got some friends to buy it, then it went down. Well, now it's kind of hard to sell it, and you're still confident in it, and you don't want to be proven wrong, so you want to hold it, even though maybe your friends will sell, but you want to hold it to a point where it does make the money. You can say, see, I told you. And that is a problem because most stocks that start heading down continue to head down. And you don't adjust for, you may have made a mistake in your analysis or your thinking, and you don't adjust for it. And you get yourself into a big problem. Representativeness, you draw strong conclusions from a very small sample. And you underestimate random chance. Or you're really just not putting up, not getting enough information, not getting enough data, and you're basically saying, okay, I looked at the stock and it's gone up every day for the past 5 days. I'm going to buy it because that's my only data I'm looking at, and that's what I'm going to use. And you may not know that maybe they had a couple of random events or random news that's not likely to occur that push the stock up higher. It's not going to happen on a continuous basis. So there are, you don't want to be too narrow in your focus of your research in investing in stocks. And talking about being narrow, a similar bias is narrow framing, where your analysis is in isolation. You're not looking at the bigger picture. You have a very closed-minded or narrow approach to valuing the stock. And people, luckily you're young right now, so you have a very open mind. But as people get older, they have a much more closed mind. Have you ever dealt with your parents or older people, and you talk about some new concept, new music, new art, a new movie, something new, and they just dismiss it completely? No, I don't do that. They just won't even listen to you try to describe it or discuss it, or they're not open to any new ideas. And that is a really bad thing to be like that in the stock market, because you miss out on a lot of good new technologies and ideas that are coming up that can be wonderful stocks. If you can't recognize early on how wonderful the iPad was, you missed like a doubling or tripling of Apple. If you can't figure out how great the iPhone was when it first came out, or the iPod, you missed a lot of potential growth. If you can't figure out early on how revolutionary Under Armour shirts and sports equipment was when it first came out, if you keep saying, you just stick to the old way and never really open up and experience any potential new ideas and new concepts, if you just really lock yourself in, there are people I know, I'll tell them about a new TV show that's good. Oh, no, I don't watch anything new. I just stick to reruns of this show, or, there's a lot to offer in life, so you want to, people can be like this with food. Ever know somebody that's just, I don't eat this, or I don't eat that, or this class of food, and it's like, well, have you really tried it? Because I didn't like it or the first either, but you try it, and it's, coffee can be like that with some people. I knew a lot of people that just swore by tea, usually just tea, just drink tea, and then they taste coffee, and slowly, Starbucks has a plan to convert all the Chinese citizens to drinking coffee, because they're big on tea. But they're slowly but surely trying to convince them to drink coffee. And you know what? In some areas, it's working. All right. Belief preservation. This is basically close to being closed-minded, but whatever your beliefs are, you're going to ignore any conflicts with your existing beliefs. And let's talk about a touchy subject. Most people have a religion they belong to, and that's sort of your belief. And then someone wants to talk to you about a new religion. Maybe you get a knock at the door, hi, we're Jehovah's Witnesses, or you're at the airport and someone comes up to you, and you're very closed-minded about changing your religion. And that's understandable, but because you want to preserve your belief. And if you believe in a particular religion, and you spend a lot of time devoting and worshiping to it, it's very hard for you to be open to a different religion or changing your religions. And that makes sense for religion, but it doesn't make sense for stocks. If whatever your beliefs are about what stocks to buy, what companies to be invested in, what ways of researching stocks, you have to be open to new and better ways, because that's how people make money in the stock market. Is they change the dynamic. They look for new and better valuation models, new and better stock concepts or company concepts, or a new way of doing things that change the industry. disruptive technology that changed the way, just like the music industry was disrupted by MP3s and downloadable content, and the way magazines and newspapers were disrupted. And there are a lot of people that said, I will never read a book on a tablet or a computer, and you'll see how much that has changed in the last 10 years. And you probably still know some people who won't read a book unless it's in a book format. And in the beginning, I sort of felt like that. And then when I tried it and dabbled with the readers and tablets, and especially with the Retina display, I said, this is actually better. I can have like 15 books in here. I can go on a plane and not have to have a stack of magazines. And, it's pretty convenient. Familiarity bias, where you want to buy stocks that are familiar to you, whether or not the stocks are good or bad. And sometimes there are certain brands or stocks that we all know about that you may have a tendency to want to buy at first. But some stocks are just very sluggish. Like Microsoft for many years was at around between $25 and $30 for like 10 years. So even though you would think, I know Microsoft is a good company, I want to buy it, it's not always, just because you're familiar with it doesn't mean it's a good stock. Sometimes becoming familiar with stocks that are less familiar or less people know about, that are about to become more popular or more well-known, is you want to get in there first. So you want to be open to that familiarity. Okay, stock market return, predictability. Some people believe it's profitable to buy underperforming stocks when they're out of favor. And I've done this a few times. I bought cigarette companies when they were out of favor. I bought oil companies when they were out of favor and oil prices were low. Sometimes it gets to a point where things are just so out of favor that the stocks are so ridiculously undervalued that eventually stock prices are going to go back up. Certain things are going to come back around. So at some point things may come out of fashion or just, people are hating on it right now. But at a certain point, that turns around. There was a point where people hated on internet stocks. After the internet crash in 2000, Yahoo was trading at $7. Priceline was trading at $2. Now it's $1,200. Things come around. So if you looked at those a lot of those internet companies deserve to crash and burn and go out of business. But if you looked around, there's a number of them like eBay and Yahoo. They're just not, Amazon. They're just not going anywhere, So buy them when they're down. The problem is it's very tough to stick to that because sometimes they keep going down after you buy them, and it could be a long wait before they turn around. Hopefully you can get in right at the bottom before they turn, and that's really difficult. Momentum stocks, prices go up and down. They tend to be in trends and continue for periods of time. So if you see a stock, buying stocks that have upward momentum generally continue that upward momentum for a specific period of time. So the only risk of buying those momentum stocks is getting them at the peak, and then they go down. So if you could identify a momentum trend early on, within the first week or first month or two of that momentum, generally the momentum trend can last for 6 months to a year to even 2 years. So if you can get in and discover what's a momentum stock, and it's really just looking at a chart that goes like that, is moving upward. And value stocks tend to outperform growth stocks. And, one reason I think this is because people generally overvalue growth stocks and the growth story, and those have high valuations. And value stocks are really, people just don't find them sexy anymore, care about them. The growth story isn't there. They're just more of a slow but steady type of stock, and they sometimes, in certain environments, they can be more punished. They're in like 1999, the growth stocks were wildly overvalued. Some of them had PEs of 100 when the average PE is more like 15. And then the value stocks, the tried and true stocks that had no technology involved in them, had PEs around 10. So there's an example where you can see these growth stocks are going to underperform, and these value stocks will perform better. So investor behavior is what drives a lot of what happens in the market. So investors who believe they are superior, they have superior information, and they tend to trade more, statistically are shown to have lower returns. So overconfident investors who trade a great deal and think that, they almost have a gambling type of behavior, typically have lower returns. And that's why day traders never last a long time. They may have a hot streak, but eventually I've never met a day trader who, over a 5-year period came out with more money than they started with. Investors tend to sell stocks that have risen in value rather than decline. So this is a problem. This is picking the flowers and leaving the weeds. So if you have stocks, and this is like I got caught up in the same mess when I sold Apple. I bought it at 13 and sold it at 29. Split adjusted, it would be more like buying it at, I think, $2 and selling it at 10 or something like that. But there's been a lot of splits along the way. But that was a really good flower that I picked that I should just let go all the way to 600. Or split adjusted, it would be like 1800. But I kept other stocks that didn't do as well because I thought that, eventually I'm going to wait for them to grow into flowers. But you know what? Weeds never grow into flowers. If you have stinky, disgusting weeds in your portfolio that were a mistake that you bought and you thought they were a flower, they turned out not to be good and they're going down, statistically you should sell them. If you have stocks that are doing good and moving up and gaining in stock price, you should keep them because they will continue to grow and do better. So investors like to act on emotion instead of facts. And this is what reduces the market efficiency because we all react on fear. Like last week, the fear index went up and people were worried about ISIS and people were worried about Ebola and people were worried about the European economy and the stocks were going down quickly and people had all this fear. And all of a sudden the earnings reports came out and they were good and people said, oh, forget about all that stuff. Earnings are good. And they just forgot about all those fears and the market came right back because you know what? Companies are making profits and they're doing good and that's what investors care about. Okay, looks like we're just about out of time, so I'll finish this up next Wednesday because we have the test on Monday. Remember to study for that. And I'll report any of that.